When most people think about banking, they imagine a checking account, a debit card, and perhaps a mortgage. But behind the scenes, banks divide customers into different tiers based on income, assets, and financial needs. The experience of someone with a few $1,000s in savings can be dramatically different from that of a millionaire or billionaire. Today, I'm going to explain how banking tiers work, from everyday retail customers all the way to ultra-high net worth individuals who receive exclusive private banking services. I'll also explore the latest developments in wealth management and private banking in 2026, a year when banks around the world are aggressively competing for wealthy clients and expanding premium services. Let's start at the bottom of the ladder and work our way up. The first tier is what banks call retail banking. This is where the vast majority of people fall. Retail customers typically use basic products such as checking accounts, savings accounts, debit cards, personal loans, auto loans, and credit cards. For these customers, banking is largely standardized. Most services are delivered through mobile apps, ATMs, websites, and branch networks. Banks focus heavily on digital convenience because serving millions of customers individually would be extremely expensive. In recent years, competition from digital banks has pushed traditional institutions to improve mobile banking features and introduce subscription-based banking packages. Some banks are now bundling banking services with insurance and lifestyle benefits in an effort to increase customer loyalty. The next level is often called the mass affluent segment. This group usually includes professionals, business owners, and investors who have accumulated meaningful savings and investments. Although exact requirements vary by institution, mass affluent customers often maintain between $100,000 and $1 million in investable assets. At this level, banking becomes more personalized. Customers may receive access to dedicated financial advisors, premium credit cards, investment accounts, and preferential lending rates. This segment is becoming increasingly important for banks because wealth growth among upper middle class investors continues to accelerate. Many institutions view these clients as future private banking customers and invest heavily in building long-term relationships. As customers accumulate additional wealth, they enter the high net worth category. A high net worth individual, commonly known as an HNWI, typically possesses at least $1 million in investable assets, excluding primary residences. Once clients reach this level, banks often move them into specialized wealth management divisions. Wealth management differs from traditional banking because the focus shifts from transactions to long-term financial planning. Instead of simply offering checking accounts and loans, wealth managers help clients build investment portfolios, reduce taxes, plan retirement strategies, manage risk, and transfer wealth to future generations. In 2026, wealth management firms are increasingly using artificial intelligence to provide more personalized recommendations, while still relying on human advisors for complex decisions. AI-powered analysis is helping advisors evaluate portfolios faster and identify opportunities tailored to individual client goals. The next level is private banking. Private banking is typically reserved for clients with several $1 million in investable assets. While requirements vary significantly, many private banks seek clients with at least $2 million to $5 million in assets. Private banking offers a significantly higher level of service than ordinary wealth management. Clients often receive a dedicated relationship manager who acts as a single point of contact for nearly every financial need. These specialists coordinate investments, lending, tax planning, estate planning, and even philanthropic activities. The goal is to create a highly customized financial experience. Private banks may also provide exclusive investment opportunities unavailable to retail investors, including private equity funds, hedge funds, private credit, and specialized real estate investments. Industry reports show that private banking is evolving rapidly. Wealthy clients increasingly expect institutional-grade investment expertise, broader access to alternative assets, and sophisticated advisory capabilities once available only to major institutions. Another major trend in 2026 is the growing importance of the so-called everyday millionaire. Traditionally, private banks focused almost exclusively on extremely wealthy clients. However, banks are increasingly targeting individuals with between $1 million and $5 million in assets because this segment is growing rapidly and represents a significant opportunity for future wealth expansion. Beyond private banking lies an even more exclusive category: ultra-high net worth individuals, commonly known as UHNW clients. Most financial institutions define UHNW clients as individuals with at least $30 million in investable assets. This group represents only a tiny fraction of the population, yet controls an enormous share of global wealth. Recent wealth reports indicate that ultra-high net worth individuals experienced some of the strongest wealth growth in recent years, benefiting from stock market gains, artificial intelligence investments, private equity opportunities, and alternative assets. Despite representing a very small percentage of wealthy individuals, they control a disproportionately large share of total wealth. Serving these clients requires an entirely different business model. For UHNW clients, banking often extends far beyond investment management. Banks may assist with family offices, succession planning, international tax structures, philanthropic foundations, private aviation financing, luxury asset acquisition, and multi-generational wealth preservation. Many institutions now operate dedicated UHNW divisions because the needs of these clients differ dramatically from those of ordinary millionaires. Recent industry moves show major banks expanding teams specifically focused on ultra-wealthy families and entrepreneurs. At the very top sits the family office model. A family office is often created when a family's wealth becomes so substantial that it effectively operates like a private investment company. Instead of relying entirely on a bank, wealthy families hire dedicated professionals, including investment managers, accountants, lawyers, tax specialists, and estate planners. Some single-family offices manage billions of dollars across global investments, private companies, real estate holdings, and philanthropic initiatives. In many cases, private banks compete aggressively to serve family offices because these relationships can involve enormous amounts of capital and generate substantial fee income. The competition for wealthy clients is becoming more intense worldwide. For example, major global institutions continue expanding wealth management operations through acquisitions and strategic hiring. Industry leaders increasingly view wealth management as one of the most stable and profitable areas of banking. In Japan, financial firms are actively increasing their focus on wealth management as investors shift money from traditional savings accounts into investment products. Some firms are expanding advisory teams and seeking to manage tens of billions of dollars in additional client assets. Meanwhile, private banking itself is becoming more technology-driven. Artificial intelligence, automated portfolio monitoring, open finance platforms, digital onboarding, and advanced analytics are transforming how banks serve clients. Rather than replacing advisors, technology is enhancing their capabilities and enabling more personalized service at scale. Wealth managers can now monitor portfolios continuously, identify risks faster, and communicate insights more efficiently than ever before. Another major force shaping banking tiers is the largest wealth transfer in history. Over the coming decades, trillions of dollars are expected to move from older generations to younger heirs. Banks are investing heavily in digital experiences, sustainability-focused investments, and alternative asset offerings to attract the next generation of wealthy clients. What's fascinating is that the gap between banking tiers continues to widen. An everyday customer may receive basic digital services and standardized support. A mass affluent customer gains access to advisors and premium products. A millionaire receives comprehensive wealth management. A private banking client enjoys customized financial solutions. And an ultra-high net worth family may effectively have an entire team managing every aspect of their financial life. Yet despite these differences, all of these customers remain critically important to banks. Retail banking provides scale and deposits. Mass affluent clients represent future growth. High net worth investors generate advisory revenue. Private banking clients deliver substantial profitability. And ultra-wealthy families create some of the most valuable long-term relationships in global finance. As we move through 2026, the banking industry is transforming faster than ever. Artificial intelligence, digital platforms, alternative investments, and growing global wealth are reshaping how financial institutions serve clients across every tier. At the same time, banks are competing intensely to attract affluent and wealthy investors, recognizing that wealth management and private banking are becoming central drivers of future growth. Understanding these tiers helps explain why two customers can walk into the same bank and receive completely different experiences. The products, advice, access, and level of personalization all depend on where a client fits within the banking hierarchy. From everyday checking accounts to billion-dollar family offices, modern banking is no longer a one-size-fits-all industry. It is a carefully structured system designed to serve customers at every stage of wealth creation, preservation, and transfer. And in 2026, that system is becoming more sophisticated, more personalized, and more competitive than ever before.